Hello. In GCSE business studies, you'll probably be asked about performance ratios, that is, judging how well a business has done and comparing that to how it's done in previous years, or comparing it to another business at the same time. You need to know these three performance ratios: return on capital employed, gross profit margin, and net profit margin. You need to learn the equations, and you need to be able to interpret the results that you're given. So, return on capital employed is calculated in the following way. It's calculated by profit divided by capital employed times 100. And that will give you a percentage. Gross profit margin is calculated by gross profit divided by sales turnover times 100. That will give a percentage as well. Finally, net profit margin is calculated by net profit divided by sales turnover times 100. And this also gives a percentage. This isn't too difficult to learn, but what's more difficult to learn is how do you interpret the results you get. Let's imagine that your return on capital employed gave a percentage of 15. What does that mean, 15% ROCE? It means that for every $100 of capital tied up in the business, that year, each $100 of capital generated $15 of pure profit. It's the return given by the capital employed. It's a ratio of the profit to the capital. 15% wouldn't be bad necessarily, but you'd have to compare it to another business, or you'd have to compare it to previous years for the same business. Gross profit margin, what does this show? If this gave a value of 30%, it would mean that 30% of all the sales turnover was gross profit. Or for every $100 of sales turnover, there were $30 of gross profit. But don't forget, gross profit is not final profit. You still have to take off expenses, indirect costs. We'll see what happens then when we look at net profit margin, because this includes after we've taken off expenses. This is the pure profit as a ratio of sales turnover. It must be smaller than gross profit margin. Let's imagine that we calculated it from some figures and we found that net profit margin came to 10%. This would imply that 10% of all the sales turnover that a business receives is pure profit after all expenses have been paid. Not tax, before tax, but nevertheless it is telling us that 10% of the sales turnover is straight profit. This has to be smaller than this, and sometimes we don't get enough information to calculate both of these. Certainly this is of more use to us. But if we're not given the information where we can distinguish between gross and net profit, we can calculate just a simple profit margin, neither gross nor net. A profit margin is simply profit divided by sales turnover times 100. Using these figures, we can judge the past performance of a business. These are not suitable ratios for judging how well a business is set for the future, but nevertheless, these are very common questions on the GCSE Business Studies exam, and certainly you must learn the equations and learn how to interpret them. Thank you.